Welcome to today's Explainer. Today, we are diving into something completely unconventional. We're looking at a fascinating 200-year roadmap of market behavior that claims to uncover the hidden architecture of global finance. Now, whether you're a Wall Street veteran or just casually follow the markets, the framework presented in this source material is intellectually demanding and honestly, absolutely fascinating to unpack. We aren't looking at interest rates or earnings reports today. Nope, we are looking at the cosmos and human biology. We're going to impartially map out what the author calls the geometric blueprint of market volatility.
Okay, so before we get into the heavy mechanics of this theory, we have to grasp its foundational concept, which the text calls mood density. According to the source document, market movement isn't just a reflection of monetary policy or capital allocation. Instead, it's treated as an actual, measurable, biological, and electrical state of collective humanity. Think of it like this. The text proposes that this mood density is driven by fluctuations in human electrical current, and that it correlates directly with the Dow Jones over a massive 200-year timeline. Essentially, if you can track the underlying conditions that generate mass human stress or optimism, you can exactly map the Dow. It's a huge pivot from traditional financial analysis, right? It sets us up for a completely different kind of deterministic predictive model.
Here is our agenda for today. First, tracking human mood density. Then, the 22-body planetary grid. Next up, the Geomagnetic Engine. After that, we'll look at the geometric certainties of crashes. And finally, the 2026 support void.
Section 1. Tracking human mood density.
The source material bases its claims on a really comprehensive four-tier chart of market behavior that spans 2 whole centuries. But again, we're not looking at fiscal policy here. The text argues that the market's mood density is actually governed by distinct structural and energetic layers. Today, we're going to zero in on the 2 most critical drivers of this 4-tier system. First, there's the primary structural framework, identified in the text as Tier 1, the 22-body planetary grid. Then we have the power source that interacts with that framework, which is Tier 3, the geomagnetic engine. According to the document, to truly understand the Dow Jones, you have to comprehend how these specific tiers lock together to dictate human behavior and market liquidity on a mass scale.
Moving on to Section 2, the 22-body planetary grid. So, the document defines this structural grid through a mechanism it calls latitudinal declination. Here's how it works. The text argues that the mathematical positions of 22 specific planetary bodies interact to form what it classifies as Tier 1, the algebraic sum. As these 22 bodies move in their latitudinal declination, their interactions yield a literal algebraic sum that fundamentally establishes the baseline mood of the market. It maps out distinct, calculable periods of either high planetary stress or low planetary stress. Basically, the text asserts that this cosmic geometry acts as a massive, invisible scaffolding, directly dictating the collective emotional baseline of human beings here on Earth. When that Tier 1 algebraic sum reflects extreme stress, human mood is, structurally speaking, compromised.
Section 3. The Geomagnetic Engine. If the Tier 1 planetary grid is the invisible scaffolding, well, Tier 3 is the power source. The material identifies solar cycles as the geomagnetic engine that drives the market, and it uses hard data for this, specifically pulling from NOAA and the GFC German Research Center for Geosciences, to track what it refers to as solar voltage. Now, the blueprint asserts that fluctuations in this solar voltage interact intimately with the stress periods of the planetary grid. This is where it gets really interesting. The document introduces a mechanism called the admatose freeze. According to this theory, during a solar minimum, which is a period of critically low solar voltage, the overarching human electrical current drops drastically. And when that human electrical current plummets, market liquidity literally vanishes, triggering an admatose freeze. It's this continuous interaction between the Tier 3 geomagnetic engine and the Tier 1 planetary scaffolding that fuels the violent swings of the Dow Jones.
Section 4. Geometric certainties of crashes.
To back this all up, the document rigorously tests its theory retroactively against some of history's most devastating financial events. We're talking the historic 1929 market crash, Black Monday in 1987, and the 2008 global financial crisis. Traditional economics views these as distinct anomalies, right? Maybe triggered by bad policy or unique economic bubbles. But the blueprint looks at the timeline of the Dow Jones and claims, actually, they share an identical underlying mathematical signature. For our analysis today, we really want to focus on the 1929 crash, which the text categorizes as the 1929 analog. This serves as the ultimate structural benchmark in the document. It's a specific historical moment where extreme planetary stress met cripplingly low solar voltage.
The text breaks this down into a very precise formula for market collapse. Step 1, the Tier 3 geomagnetic engine experiences low solar voltage, triggering that drop in human electrical current. Step 2, this admatose freeze coincides perfectly with high planetary stress on the Tier 1 algebraic sum. When those two specific layers, a failing power source and a highly stressed architectural grid, align, the text states it leads to Step 3, a geometric certainty. In this view, a crash doesn't happen because of panic over breaking news. It happens because the mathematical framework dictating human mood density demands a collapse. The structural integrity of the market simply buckles under the synchronized cosmic and electrical stress.
And the source text is incredibly absolute in its terminology here. I want to read a direct quote from the document because it really anchors the deterministic thesis we're exploring. It says, "The 1929, 1987, and 2008 crashes were not random news events, but geometric certainties." The author is arguing for a totally inescapable view of market volatility. In this framework, collective human emotion and the resulting financial ruin are literally the mandatory results of low solar voltage and high planetary stress locking together.
Which brings us to Section 5, the 2026 support void.
The document draws a really sharp contrast between those historical crashes and its projection for the year 2026. In the past, especially looking at that 1929 analog, the market collapsed because low solar voltage met high planetary stress. But crucially, the grid structure itself still mathematically existed. It was just under severe stress. For 2026, however, the blueprint projects something entirely unprecedented. It forecasts a reset. And this isn't characterized by high stress on an existing grid. No, it's characterized by the complete absence of mathematical parallels. According to the text, the structural architecture itself simply evaporates.
The document defines this incoming 2026 event as a support void. And to be clear, it doesn't categorize this as a brief, severe crash. It describes it as a mathematical state where absolutely no planetary parallels exist to hold the market up. It represents the total cessation of the 200-year cycle's foundation. That Tier 1 scaffolding that systematically supported human mood density and the Dow Jones, it just ceases to exist. It's an absolute void of geometric support.
So, based purely on the structural mechanics detailed in the text, the interaction of human electrical current, the Tier 1 algebraic sum, and the admatose freeze, we are left with the document's central lingering question. What happens to a market when the mathematical foundation holding it up simply vanishes into a support void? The text actually answers this with a stark forecast it calls the 2026 vision. The 2026 void isn't just an ending, it is a brutal beginning. According to the blueprint, the collapse into the void initiates a full century of foundational reconstruction. It asserts that it will take exactly 100 years, leading us to the year 2126, to slowly build a completely new mathematical market architecture from the ground up. It is a wildly provocative, century-long forecast, and it challenges absolutely every assumption we hold about the continuity and stability of modern global finance.